Welcome to Weekend Investing Daily Bytes. We are shooting episode 194 on 15th of March. Today's topic is on rising revenues and falling stock prices. Some example that we will take here to showcase that stock movement need not be linearly in proportion with the numbers that the companies give out. Anyhow, so let's take a look at the market first. Also, this special announcement. On this holy weekend, we will be opening a few slots on all our popular strategies that are closed for subscription. MI25, MT All Cap, MIATH and MIATH2 will all be open from Thursday afternoon 4 p.m. till Monday morning, or till those slots are there. And you can read more about these strategies on the Weekend Investing Hub if you like. This day today was marred with two-way movement. Virtually, the market had been going up on a singular trend for the last 4 or 5 sessions, and it was expected that some breather the bears will be able to get, but I was not expecting a sharp cut as it happened today in the indices. And Nifty, although it closed 1.2% down, it was much lower during the day. And the fear seems to be stemming from the fact that the Fed is meeting tomorrow night, India time, for the first of the many interest rate hikes that are planned. And as the interest rates go up in the US, capital tends to move out of emerging markets towards the US. So that, but it has already been happening. So a lot of this is discounted. But nevertheless, when the event happens, there is some jitters on that day. So metals were thrashed badly. Also, the Ukraine war, although has not ended, but the market seemed to be completely discounting it. And maybe the market knows more that the war may be coming to an end. We don't know yet. But it seems that oil is back from $139 to $100. Gold is back from 2070 to 1925. Metal stocks, commodity stocks that were running have also cooled off. Metals, in fact, were down 4%. Commodity stocks minus 2%. So it does seem like that the trend is reverting to the normal, but we really can't say for sure. So with this small hiccup today, and I'm assuming that the rumors about long-term capital gain being re-looked at by the government for the next budget also was causing some discomfort in the market, which was later on denied by the government that there is any such thought process going on. So that also may have caused the second half some part recovery that happened. So many queues opening up for the rest of the week. Hong Kong stocks, especially the technology stocks, getting battered mercilessly in the last 2 days, and in the last 1 year, it's down about 70%. The technology index. In the last few days itself, big stocks like Alibaba, JD.com, Baidu, Tencent have been crazily, mercilessly beaten down. So there is some thought there that money is moving out of Nasdaq, money is moving out of Hong Kong technology, money has been moving out of Russia, of course. So there may be some rotation into the markets which have not fallen. So as some JP Morgan report is out yesterday saying that there is a rebalance on a global scale that will happen by the end of March, and it will push more money, $300-400 billion into equity, into markets that are doing well. So India should get its share from that. But for today, the entire universe of small, mid, and large caps were down 3/4% to 1.25%. And several of our strategies were also hit. MIATH, EverGreen, MI25, MI20, MI30 were all down more than 1%. MIATH2 was down the least at minus 0.46%, and others between them. So not a very attractive day today, but after 4 or 5 days of run, this was due in some way. In terms of top gainers, Linde India, Minda Corp, Linde India up 11%, Minda Corp up 7%, Himadri, Polyplex up 7%, Supreme Petro up 7%. So huge gains in some of these stocks may have been also the beneficiaries of the PLI scheme that is being announced. After a few days, we have seen a dramatic correction in some sugar stocks, but this is coming on the back of a huge run, so not really any change of trend. The Balram Chini was down 7%, along with some other sugar stocks like Dhampur, and Sharda Crop was down 6%. Tube Investment, Mindtree, and TATAELXSI down about 5 to 6%. These were the major movers of the market. So the theme that we are trying to explain here is how we tend to look at corporate numbers and try to extrapolate that to the share price. That may or may not happen at all times. And the example that we are taking today is that of Netflix, listed in the US. So you can see that Netflix has had a tremendous growth of subscribers right from 2001 leading up to 2020. And you can see here, even in this chart, it is visible that quarter one 2021, the incremental growth in subscriptions were muted. And if you look at the charts for uh, Netflix, you can see that. Let me see if I have a longer term chart here. No. So Netflix has been going up since a while, but in the last couple of years, it had slowed down. Stock price not rising along with the subscribers, but then post COVID, there was another resurgence in the stock, given that most people were home and watching a lot of Netflix, and that has totally given back the entire move. So this is the COVID fall here, and you can see that the stock is even below the COVID pre-pandemic levels, and in fact, it is at the same level as 4 years back. So May 2018, this current level was reached for the first time. And while if you look at the last 4 years of subscription, you are seeing that this there was a very strong growth that was happening both in number of subscribers, in terms of revenues, in terms of profits. But what is happening is that these initial years of 2010 to 2018, the stock price jumped so much that it actually discounted the growth for the next many years. So while people who came in 2018, 19, 20 were expecting the same kind of stock performance, the stock had already discounted, growth for next many years based on certain number of subscribers coming in, and the stock already trading at very high multiples. So this is just an example of how stock prices can really run ahead of the fundamentals. And while you may be coming in at a time where the fundamentals are very strong today, so if you're coming in today into a company, fundamentals look very strong today. There has been fantastic growth in the past couple of years, but you really cannot say how much of that growth is already built into the stock price today. And that is what is the usual surprise that most people get once the stock starts to fall, that the company is growing, revenues are growing, profit is growing, why the stock is not going up. So this is a typical sort of pitfall that fundamental investing leads people into. But of course, over a very long period of time, if the company is doing well, this will come back. Now, having said that, let me also show you MSCI China index performance. We all know the Japanese story, that went up 4x in 1980s, and from 1990 onwards, it has come down dramatically and still not crossed those levels. And just look at MSCI China index performance. You can see in the last 30 years, virtually there is no return. So, the first uh, 10 or 12 years were spent in going to a drawdown of minus 80%. And then from here, of course, there has been run. So people who got in somewhere in this period still have some returns, but somebody who came in 92, 93 is sitting with really no returns for 30 years. So this is another example of why you should not be bringing in lump sum investing into a market which is already frothy, for instance. And here, if somebody had brought in the capital gradually over time, they would have got the benefits out of it. Or even during this rise, if you had gradually brought your capital in, you would have seen some gains of it. Of course, in the last leg, you would have lost a substantial part. So China, Hong Kong markets, Nasdaq, they're all really very, very shaky and weak right now, which makes me believe that, in case this contagion sort of spreads, it may hamper other markets like India also. But so far, by God's grace, we are not yet impacted by any of this. Another favorite stock, Alibaba, it has been dramatically falling for the last 1 year from around 300 levels to nearly 70 to 75 levels, about 75% drop in a market leader stock, which no fundamental investor will say don't buy it, but people have been buying it at every level. Even Charlie Munger has said that he has been buying it at every level. So this is the sort of the tough part of long term fundamental investing. It is fine that you found value, but the stock price is not hostage to your find. You may have found something at good valuations according to you. Stock price may not agree with you, right? So unless you have the stomach to sit through these kind of jaw-dropping drawdowns, you should wait for more clearer signals that the stock is moving up and have exit strategies in place. And of course, position sizing is very important. I know people who are heavily into Alibaba stock in terms of percentage of their portfolios, and it is really difficult for them right now. So if you had kept position sizing in mind, if your portfolio is diversified across 20, 30 stocks, across geographies, across asset classes, diversification is there, then one entity or a few entities going down will still not hurt you as badly. So concentrated betting has its advantages and disadvantages, and this is a typical disadvantage on that. So with this, I come to an end to this weekend investing daily bite. I hope you're liking it. Please like the videos. Please subscribe to the videos. Please share it amongst your friends if you like them. And I'll see you in another video. Bye.